Welcome to the Microcap Brief, the show that demystifies the world of microcap investing. Last time, we talked about the external pressures companies face. Today, we're going inside the machine. We're exploring a force that can quietly reshape your investment from within, a concept every microcap investor must understand: dilution. Think of it this way. Dilution isn't a sudden market crash. It's more like a slow, silent leak in your tire. If you're not paying attention, you might look up one day and wonder why your investment just isn't moving the way you thought it would. We're going to show you how to spot that leak, understand why it's happening, and decide if it's a sign of a company building a rocket ship or one that's just running out of road. So, what is dilution in the simplest terms? Let's use the classic pizza analogy because it's perfect. Imagine you and 9 friends buy a pizza, cut into 10 slices. You get 1 slice. You own 10% of that pizza. Simple. But the pizza shop owner, the company CEO, comes to the table. He says, "I have a brilliant idea for a new, amazing truffle topping that will make this the most popular pizza in town. But I need more money to buy the truffles." To get that money, he doesn't ask you for more cash. Instead, he just makes the pizza bigger, adding 10 new slices and selling them to a new group of people. Now there are 20 slices in total. You still have your one original slice, but your ownership has just been cut in half. You now own just 5% of the bigger, truffle-topped pizza. That is dilution. The company created new shares, new slices of pizza, and your piece of the pie got smaller. Now you might be thinking, wait, but the pizza is better now. It has truffles. And that is the absolute core of the issue. Dilution isn't automatically a bad thing. For small, growing microcap companies, selling ownership is often one of the only ways to raise the money they need to survive and grow. The critical question you must always ask is this: is the value of the truffles worth your smaller slice? Is the company using the new money to create so much future value that your 5% of the new bigger pizza will be worth more than your original 10%? So how does this happen in the real world? There are 3 main recipes for dilution that you'll see in company filings. Number 1, the straight-up share sale. This is the most obvious. The company simply sells a new batch of shares to the public or to private investors. Every new share created makes the total number of shares bigger and your ownership percentage smaller. Number 2, the convertible deal. This one's a bit more complex, but incredibly common. A company might take out a loan, but with a special twist. Instead of paying the loan back with cash, the lender has the right to convert that debt into shares of the company, often at a discount. When that conversion happens, poof, new shares are created out of thin air, and everyone else's slice gets a little bit smaller. Number 3, the golden tickets. These are warrants and options. The company gives them to investors as a sweetener or to employees as a bonus. A warrant or an option gives the holder the right to buy a share of stock at a locked-in price in the future. When they exercise that right, the company issues a brand new share to them, adding to the pile and diluting everyone else. Okay, so why is this a huge deal for microcap investors? First, your ownership and power shrink. Your vote counts for less, and your claim on future profits gets smaller. Second, it can crush a key metric called earnings per share, or EPS. Imagine our pizza company finally makes a $20 profit. With 20 slices outstanding, that's $1 of profit per slice. But if they had never diluted and there were still only 10 slices, it would have been $2 of profit per slice. Even with the same total profit, dilution made the per-share value look worse, which can hurt the stock price. But most importantly, how a company manages dilution tells you a story about its leadership. Is management raising money at any cost, signaling desperation? Or are they strategic, with a clear plan to create value? Disciplined management raises money to build a faster car. Undisciplined management raises money just to keep the lights on for another month. So here's your mission. Dilution isn't the enemy, but uninformed dilution is. Your job is to be the informed investor. When you see a company raising money, don't just panic. Ask the right questions. Pull up their filings, the 10Qs, the 10Ks, and especially the 8Ks that announce these deals. Ask yourself, why do they need this money? Is the plan credible? And are the terms of the deal fair? By understanding how dilution works, you transform from a passenger into a navigator. You can see where the company is headed and why. You can judge whether that new truffle topping is a gourmet game changer or just an expensive distraction. Thank you for listening to the Microcap Brief. Until next time, stay curious, do your homework, and always, always read the fine print.